Welcome, listeners, to today's deep dive into a pivotal moment for the U.S. economy and financial markets. The Federal Reserve has signaled a significant shift in monetary policy, with plans to lower the federal funds rate from its current level of around 4.11% to below 3.5% by the end of 2026, potentially dipping closer to 3% in the years ahead. This easing cycle is sparking excitement on Wall Street, but as we'll explore, the benefits may not trickle down evenly to middle-class Americans. Let's unpack the historical context, global impacts, sector-specific effects, and what this means for your financial future. Historical context, the Fed's rate cycles and inequality. To understand the significance of this move, let's step back. The Federal Reserve's federal funds rate sets the tone for borrowing costs across the economy, influencing everything from mortgage rates to credit card interest. Historically, rate cuts, especially prolonged periods of low rates like the near-zero environment post-2008 and during the COVID-19 crisis, have fueled asset price booms. After the Great Financial Crisis, the Fed's balance sheet ballooned from $4 trillion to $7 trillion in mere months through quantitative easing QE, injecting unprecedented liquidity into markets. While this stabilized the economy during crises, it also disproportionately benefited wealthier households and corporations with access to financial assets. Stocks, for instance, have been the primary driver of wealth growth for the top 0.1%, whose net worth has nearly doubled to over $23 trillion since 2020. Meanwhile, younger and lower-income households, who rely more on wages than investments, have struggled to keep pace. This isn't a new story. The Gini coefficient, a measure of wealth inequality, has steadily risen in the U.S. over decades, exacerbated by monetary policy that often amplifies asset inflation. As rates fall, cash in savings accounts earns less, pushing capital into riskier assets like stocks, real estate, and alternative investments such as private equity or Bitcoin. The result? A widening generational wealth gap, where baby boomers and retirees with significant stock holdings thrive, while younger generations face unaffordable housing markets, where a six-figure income is now often required to qualify for a mortgage, far above the median household income. Global and sector-specific impacts. Globally, the Fed's actions ripple far beyond U.S. borders. Lower rates typically weaken the dollar, making U.S. exports more competitive, but increasing import costs, which can stoke inflation, a burden that hits lower-income families hardest. Emerging markets, often reliant on dollar-denominated debt, may see temporary relief as borrowing costs ease, but they remain vulnerable to capital outflows if U.S. markets become too frothy. Meanwhile, in developed economies, central banks often follow the Fed's lead, potentially triggering a synchronized global easing cycle that could further inflate asset prices worldwide. Sectorally, the impacts are starkly uneven. Big corporate borrowers like Apple benefit immediately from lower rates, slashing their borrowing costs and freeing up capital for investment or share buybacks, which often boosts stock prices. Financial markets are already buzzing, with 2025 projected to see a record $1.25 trillion flow into exchange-traded funds, ETFs, as passive investing gains steam. However, for consumer-facing sectors like auto loans or mortgages, the benefits of rate cuts filter through more slowly and require deeper cuts to make a meaningful difference. Real estate, a traditional wealth-building avenue for the middle class, remains out of reach for many younger buyers, as years of low rates have driven prices far beyond income growth. Compare today's six-figure mortgage qualification threshold to 2006, when a $58,000 household income was nearly enough to qualify for a mortgage. Practical advice for navigating the easing cycle. So, what does this mean for you? If you're sitting on cash in a savings account, brace for lower yields, potentially near zero in real terms after inflation. Consider reallocating some capital into equities or ETFs, which historically outperform in low-rate environments, though be mindful of frothiness in markets like private credit or cryptocurrencies, where risk appetite is surging. For younger listeners or those with limited portfolios, start small with low-cost index funds to gain exposure to market gains without overextending into unaffordable real estate. If you're carrying high-interest debt, prioritize paying it down as rates ease, freeing up cash for investment or emergencies. Retirees, be cautious. With $7.5 trillion in money market funds at risk of dwindling returns, avoid panic selling stocks to chase yield. Diversify into dividend-paying equities or bonds for steady income. Investment and policy implications, and near-term catalysts. Looking ahead, the Fed's easing cycle carries profound implications. On the investment front, expect continued strength in equities, particularly in tech and growth sectors, as cheap money fuels risk-taking. However, the widening wealth gap poses a policy challenge. The Fed must balance stimulating growth with mitigating inequality, potentially through targeted fiscal measures alongside rate cuts, though political gridlock often stalls such efforts. Critics argue the Fed overstayed its QE programs post-crisis, inflating assets unnecessarily, and there's a risk of repeating this mistake if inflation, still above the 2% target, rebounds. Near-term catalysts to watch include the Fed's next rate decision in 2025, which could confirm the pace of cuts, and Chairman Powell's rhetoric on inflation risks. Keep an eye on housing data and consumer spending reports, as they'll signal whether middle-class families are feeling any relief. Globally, monitor dollar strength and emerging market stability for signs of broader economic stress. In conclusion, while Wall Street cheers the Fed's pivot to lower rates, the benefits are skewed toward the already wealthy, leaving many Americans on the sidelines of this financial flywheel. As we navigate this cycle, strategic investing and policy awareness will be key to bridging the gap. Stay tuned for more insights as this story unfolds, and let's keep building a smarter financial future together.